All right, guys, thank you so much and welcome. This is Stephan Piscano with the Stephan Piscano podcast. So, what we're going to do today is we're going to debunk, to me, maybe the biggest myth in real estate, guys, which is my local market is special because of XYZ. And I can't tell you, I don't know if this is unique to me because I have so many family members, friends, partners, clients all across the country that I'm having conversations with on a regular basis. But I can't tell you how many times over the last 20 years I've heard someone say, oh, well, here in Oregon, it's just our market's going to be protected because all the Californians are moving here. Or, oh, we're here in Texas and everybody's moving here from California or New York or whatever it is because we've got no state income tax. So we're protected. Or, oh, well, the market never crashes in Oklahoma. You ought to look at that. That's what actually somebody said to me last night. Or everybody's moving to Florida. Everybody's moving to Florida. We're protected. Da, 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 da. Same thing, Nevada, Arizona, Alaska. Everybody thinks their market is special. And they are special. I mean, every market's special in its own way for various reasons. Every market has advantages and disadvantages. But I have news for you guys, and this is not a popular thing to say. I would, in fact, estimate that probably 80+% of you that hear this will probably disagree at first. And I'm going to try to show you factual data to prove that I'm correct, that while your local market matters in a microcosm, and it can have some differences from the national market because of different trends and rental patterns and things of that nature. The reality of it is, guys, just like we saw in 08, 09 when the market crashed, it crashed everywhere. And it doesn't matter if you are in the mountains in Utah, if you're in luxury homes, oceanfront in Southern California, you could be in the depths of the ghetto in Detroit or New York or Baltimore. You could be anywhere. You could be from the luxury homes, multi-million-dollar homes in Park City, Utah, to the smallest shack trailer park that you could ever find in name a place. And it doesn't matter. If the market crashes in one area, it crashes in another. If the market soars like it has for the majority of the last 12 to 15 years here, it rises everywhere. And I'm going to show you the factual data to indicate that. Now, I will say it's the areas that boom the biggest when a market soars. The Phoenix, Arizonas, the Las Vegas, Nevada, the Southern California, the Florida coastal cities, the Oregon, where I used to live, that will have the biggest percentage upswings, largest dollar amount upswings when a market's booming. But then on that day in 2008, when everything seemingly almost crashed overnight, those are the areas that crash the hardest. And then the areas like Texas, Oklahoma, Midwestern states, Ohio, Alaska, that people think of as not appreciating as much, but also not crashing as much. I got news for you. While the percentages or while the dollar amounts aren't as big, percentage wise, they crash just as hard. And I can tell you that for a fact because in 2009, 2011, so on and so forth, I was buying homes in the ghetto in South Dallas in an area called Pleasant Grove, and we were buying condos that we were picking up for $11,000, $12,000 that a few years earlier were selling for $40,000 to $80,000. And there were luxury homes in Frisco and Plano and in Dallas itself that were 8,000 square foot mansions that were selling for $350,000 during the last crash. I remember I looked at a house in a town called Meridian, Idaho, that's right by Boise. And again, that's another market that you think of as ultra stable. That was on acreage. It was $600,000 back in 2012, I guess it was, that I was looking to actually put an offer on it. Horse property, beautiful 6,000 square foot masterpiece in Meridian, Idaho. And again, beautiful property, the whole deal. $600,000, about $100 a foot. That same house is going for about $4 million today. Now there's rapid inflation that's taken place over the last 10 years and all that have an impact on that too, but that's all part of the pie. That's all part of the metrics that go into this. And I tell you this really just to debunk the myth that guess what? It doesn't matter. These ancillary factors that people talk about, and even, hey, it's not really a positive thing for me to acknowledge this because it would help us sell properties if it was true. And there are factors that can benefit, really unique factors. Like we were looking at property in Los Angeles. I was looking at about, I guess 12 years ago, right around the time that they were about to announce formally, but everybody kind of knew it was going to happen, that they were going to build the new stadium there, which is SoFi now, and that's where the Chargers and the Rams play, and then now you got all that. And so you could pick up property just about doubled in value a couple of years later after that stadium was formally announced, and then once it went live. And so there's situations like that. You can have areas of economic growth that can have a higher bump on a small scale. But at the end of the day, what I'm going to attempt to prove to you today is that when there is an actual market drop, like we saw in 2008, when the stock market tanks, when the real estate market tanks by 50 to 70% on a national scale, when that happens, you can talk all you want about the Californians moving there. You can talk all you want about the tax breaks. You can talk about whatever you want. It's going to crash in your market too. It's going to dip in your market too. Maybe not as much on a dollar scale, dollar to dollar, but on a percentage scale, which is really what matters, it's going to be about the same. I tell you this is because, part of my job with this show and with the webinars we do and the educational content that we try to produce is to help everybody in my network be engaged and informed as investors first and foremost, and then realtors in the network that like the show and listen to it too. You can benefit yourself as an investor, or you can benefit your knowledge for your client base of investors that you're trying to work with. And I like to take all of the emotion out of it. If you go to a place like, we own property in Panama City Beach, and those properties are doing very well. I'm very grateful for that. That's a blessing. But I've talked with people and say, oh, it's so pretty there. The feeling is so, that means absolutely nothing. Nothing whatsoever. I don't care. You can feel, because some of the best percentage returns that I've ever had in my life as an investor have been on the ugliest properties that you'll ever see in some of the most dangerous. Yeah, in one of the episodes I'm working on now that's probably going to take a few weeks to put together, because we're going to really try to do this one big, is talking about my history with buying $1 houses in Detroit during the last crash. And these were houses that before the '08 crash were selling for, in many cases, more than $100,000, which was a lot back then in Detroit. And then all of a sudden we're buying them for $500, $600. I bought 12 of them for literally $1, which is basically a deed away from the bank. So we'll do a whole episode just on that. Those houses, percentage wise, in neighborhoods where literally houses are being set on fire and it's so dangerous that the cops don't even want to come in and the fire department doesn't even want to come in to put it out. Not an exaggeration. I'll tell you about that some other point in time. That was the best percentage return I've ever gotten in my life. In fact, I would make an argument that some of the uglier homes, some of the more dilapidated areas, are the areas where percentage-wise you can get the best return. And so that's what I want to ram in everybody's head, is when you're buying something, don't ever buy it based on ancillary factors that you're told. Buy it on percentage data, market-driven data, historical data of rental rate performance. When you base your strategy on cash flow, then you're protected regardless of the market. And that's really, those of you that have seen a lot of the content or listened to the show before, you heard me talk about it. The purchase price of a home is what I care about the least. What I care about is the amount of cash we're putting down. How can we utilize that property as a vessel to create the highest possible cash on cash return? I care about the rental history, and it doesn't matter if it rents for $600 or $6,000. It's about the percentage, because if I can get a 32% cash on cash return, even if it's on one unit that's renting at $600 a month, I would go do that 20 times, just like we did with the Detroit house. We bought literally hundreds of those, and we made a ridiculous percentage return, in the hundreds, on the ugliest houses that you would never want to even think about going and staying at. There's always an opportunity there, and I hope that ultimately there's some comfort in this, because if you don't it's these little narratives that can sway a market, and that's what led us in '06, '07, when people were buying everything up in Miami and Phoenix and Scottsdale and Vegas, and where I lived at, well, I guess I had already moved to California, but I lived in Bend right before, right during when all this was starting. The narrative in Bend, Oregon, when I bought my first house there before I moved to California, was we're going to be protected, and everybody's moving up here from California. That's not going to stop. We're always going to be cheaper than California. As long as we're cheaper than California, we're still going to continue to rise. In fact, when I was 20 years old and I bought my first house, I told my mortgage broker, I said, I can't afford that payment. And he told me, well, it doesn't matter because it's going to continue to appreciate in equity by 10 grand a month. So you're good. You can just refi it in a year. And I was like, oh, okay. I mean, I was 20 years old. So it ended up, it, it ended up, it ended up being a unique thing because when I later sold that house for a third of what I paid for it in a short sale, and I was already living in California at that time, and I hung on longer than everybody advised me to just because I was a kid and I, just on principle. But that was really what led me to utilizing or developing the seller financing model, because number one, I never wanted to be dependent on a bank again. And it also, seeing all of my mentors that I knew at the time suffer as a result of that horrific 2008 crash, it made me base my strategy on cash flow, which insulates us to some extent from whatever the market does, because I don't ever want to be a slave to appreciation, because my fundamental belief, nobody can predict appreciation. And back to the Bend, Oregon story, which is the one that's closest to me, when that guy told me that in 05, 06, by 09, Bend had seen a 60 to 70% drop in market values. At one point, they had a near 30% unemployment rate because at that time, their economy was entirely based on the real estate market. They had closed what they used to have, the mills there in town, and it was all based on this booming real estate market and tourism. And so when that tanked, that town was a ghost town for a few years. Now it's rebuilt itself beautifully, as a lot of these, pretty much all of these areas I'm talking about have. And now we've had more than a decade, really, like I said, closer to 12 to 15 years of consistent appreciation nationally. And so Bend is the most expensive real estate in the state now. Las Vegas is doing extremely well. Washington, D.C., which I'm going to talk about, is among the hottest markets in the country. All of these places that were decimated to the strongest extent from 2008 to 2012 are the ones that come back the strongest. But percentage-wise, it's all the same. And so that's why if you base your strategy on cash flow, if you don't care what it's worth when you buy it, you only care what it's worth when you buy it and when you sell it. Everything in the middle means nothing as long as you can afford the debt service, as long as you can afford your monthly payment. And so that's why you base your strategy on cash flow and generating a high cash on cash return. And that's what allows you to still be profitable during a market downturn. And, I've said this many times. I wrote an article for it for LinkedIn Pulse about, almost 10 years ago now. It was 2016. And you can find that on Medium too. Just go to Stephan Piscano Media and all that. And it's called If the Market Crashes, I'm Happy. And the logic behind that you've heard me talk about a lot is, if I buy a property for $1 million and I'm earning a 20% cash on cash return, market dips tomorrow, now that property is worth half of what I paid for it. I'm happy, and the reason I'm happy is because I'm still earning a 20% cash on cash return on the first property I bought, because as we saw in 08, 09, when the market crashes and pricing, rental rates either stay the same or actually they went up a little bit, about 2%. In 2009, the rental rates went up because of inflation and because people still need a place to live. And in that scenario, you actually saw a large influx of former homeowners that were foreclosed on that were influxed into the rental market as renters. And so that demand made it go up too. So I'm still earning 20% cash on cash on the first property I bought, which is fantastic. That's a wonderful thing. And now I'm going to go buy one just like it at half price and get a 40% cash on cash return, which is even better. So if you dollar cost average with your focus based on cash flow, not on appreciation, because again, I don't care what your realtor says. I don't care what your mortgage, I definitely don't care what your mortgage broker says, just like that guy told me 20 plus years ago. They don't know. I don't know. You don't know. None of us know what the market's going to do as a whole. But what I can tell you, and I challenge anyone, just like I was telling when I was having this debate with some family members last night, tell me Any city, any metro area, any state in 2008 or 2009, when the national markets were tanking at a historic rate, show me any metropolitan area or any state that went up during that time. And you can't, because I've looked. But I mean, if I'm wrong and you find one, then put it in the comments section, and I'll give you something. I'll give you $1,000 or something. I don't know, because you can't find it. It doesn't exist. There was a myth that I actually kind of believed. There was a story that I'd heard about, and maybe some of you heard about too, that there was one zip code in Palo Alto that during the '08 to 2012 market tank, that zip code supposedly still went up because of all the tech millionaires and billionaires that were buying there. And I always kind of believe that is because there are some outliers with this. There are really, really rare outliers where you can have some weird stuff go on in a specific zip code or city. But I tried to look that up last night, and I looked in Palo Alto, and can't find it anywhere. So if it does exist, then show me the zip code and show me the actual market data that goes with it, because I don't, it might have stayed more stable than most. And again, it's all relative, right? So if you are in Dallas, Texas, and the market booms, maybe you have an 11% appreciation one year, and maybe some other state has 6, and maybe some other state has 30 or 22, but to a general rule of thumb, water finds its level. To a general rule of thumb, if the markets as a whole are trending up, then everywhere is trending up. It's just a question of exactly how much, but the percentages are all going to be fairly similar. Now, you'll have isolated instances within a community, for example, like an HOA. Like we had some condos that we bought, the HOA was under litigation. And so at that time, the only way that you could sell those condos, banks wouldn't do financing on it. So the only way you could buy and sell those condos was if you either bought them cash or with seller financing, which is why we bought them. Once that HOA litigation was done, then you were able to buy them with traditional bank financing as well. The market on those went up 60% in 12 months. Now that's an isolated scenario, but that's not market driven to a region. That's a specific driven scenario to that HOA or to that property. And obviously you're going to have that anywhere. Say, oh, well, this market's hot because of this. Well, no, the market's hot because the market's hot everywhere. There are, again, I do want to be clear though, there are a few exceptions. And right now, the only exception that I can genuinely say I believe is accurate is Washington, D.C. metro area. And that's because there was a genuine massive increase in government hiring over the last 5 years or so. One of my brothers lives in DC. I was kind of involved in watching his home search. He didn't take any of my advice on the seller financing stuff, but I did kind of listen to what he was experiencing, and I did try to look around a bit for him there. And I can tell you that is one market that I do think has been abnormally surging, and that could abnormally dip if there actually are a lot of government layoffs, because that's a supply demand thing that is statistically factual. You can look that up. So there are outliers there. And then obviously places like Detroit, which I'm talking a lot about Detroit today. If you have a massive influx of capital, these are tangible things that you can track. Like Dan Gilbert, owner of or founder of Quicken Loans and owner of the Cleveland Cavaliers basketball team, who I actually got to meet about 11 years ago, I guess now, 2014. Really nice guy. Anyway, he during that same crash where I was buying and flipping those $1 homes in the ghetto in Detroit, he was saying that skyscrapers were on sale, and he invested hundreds of millions of dollars into the city of Detroit, just him personally. So if billions of dollars get invested in an infrastructure with an intent to prop up an area that has been destroyed, that's a real life thing that you can put something on too. But all this anecdotal stuff about, oh, well, this area doesn't crash and this one does, or this one soars and this one doesn't, it's just not accurate, guys. I'd like it if it was, that'd be cool. But the reality of it is I'm going to show you with these charts, you're going to see when it's going up in one place, it's likely going up to some extent in another. If it's going down in one place, it's likely going down to some extent in another. You're just not going to see these swings where the market is booming in Texas and it's tanking in California. Because I got news for you, with all of the stuff. And hey, I don't like the politics of California, to be clear, but I've lived here for almost, well, what, 17, 18 years I've lived here. And since I've been here, everybody's talking about everybody leaving California, and there's a lot of truth to that. And I don't blame the ones who do, because the politics and the expense of living here is ridiculous. But guess what? The market's way up in California too. So I don't know. With all these people leaving, the market sure is surging in California in a big, big way. So it's the same thing. So anyway, let me show you some. I'll quit ranting at you and rambling at you too much here for the moment and show you some actual stats. So this is the new home price index, and you can go to Mortgage News Daily. It took me a while to find a decent chart nationally. So if anybody else wants to play with this and look it up on your own, and there's no affiliation with them, this is the best one I found. And this one's going back all the way to 1980. I'm going to do a 10-year chart here. But you can see this is national. Notice the trends to 2020, and then right here, right about pandemic time, April 2020, new home prices nationally, 364,000. Nationally, it peaked April 2022, new home prices 562,400. Pretty massive increase. Now, this isn't the increase in the monthly change. This is now 1 month, March 22 to April 22. That month, the market nationally was up almost 10%, 9.89%. The annual change from April 2021 was up 33.62%. So remember that number. And I don't know, I'm doing all this blind with you. I did a little bit of research, but I'm doing it all blind here. I'm going to go off the top of my head. So now I'm going to go over here to local markets. Okay, so we're going to start with Los Angeles, California. Okay, and this is a little confusing because for this site, and it really is hard to find good sites to get this data. But we're going to hop around the country here, as you can see. That's why I chose this one, which is aei.org, and get some of the details here. But so this is for Los Angeles Metro. And I'm actually going to do year over year. So going back to the quarter that we're targeting here, look at that. So Q1 2022, market peaked in Los Angeles, just like it did nationally, up 19.8% according to this site year over year. All of these are a little bit different. Let me actually do national on this one to see if it matches up. Yeah, look at that. National 2022 Q1 up 20.6. So we'll stick with this website just so the numbers are all the same, because all of these rated a little bit differently. This one's doing a percentage basis versus a price basis. But the numbers, what we want to focus on is this percentage right here, 20.6 national. And then for Los Angeles, same quarter, 19.8. Now, and then it dips really big, 2023, and then you've seen 2024 go back up again. So let's go back to the national. Let's see how that, yep, look at that. Exactly the same. Dipped on a national level, up again Q1. So in the family discussion I was having last night, the example that somebody used was, oh, well, you must not go to Oklahoma very often because Oklahoma, it doesn't crash there. Well, okay, let's see. Oklahoma City, Oklahoma. Oh, weird. Look at that. The exact same trend as Los Angeles. So if you're ever wondering if there was anything that Oklahoma City and LA have in common, it's the pricing percentages in the index. So the exact same quarter that nationally the country was up 20.2%, and Los Angeles was up 19.8%. Oklahoma City was up 16.2%. Then the same quarter that Los Angeles tanked, or dipped a bit. I'd call that more of a dip than a tank because the value is still high. Oklahoma City did the exact same thing. Let's try another one. And again, I'm doing these all blind. I haven't looked this up, but let's do, everybody talks about Florida, and we have a lot of properties there. I love Florida. I got family there. Let's do Florida. How about Jacksonville, where I've got some family there? Exact same trends. Again, these will all be relative. The higher they go up, the more they go down. But the trends are all the same. The percentages might be slightly different, but if the market's up nationally, it's going to be up everywhere. If it's down nationally to a big level, it's going to be down everywhere. Let's look at another one. How about Dallas, Texas? Look at that, 30%. So you actually saw bigger swings in Dallas, but notice the negative percentage return when it went back down. And then going back to compare it again to Los Angeles. $19, about the same. Same trends. Actually, the numbers are slightly worse in LA than they are in some of these other areas. Let's look at Cincinnati, Ohio. This is the first one with a little bit of difference because they had a bigger boom right here than they did here. Just slight variation. Atlanta, Georgia, same thing, down. Let's look at New York. Now, New York, I think this one might actually be one of the few that could prove me wrong. Yeah, because New York really had a tough time with the pandemic. That was a real thing in a big way. But even them, similar trend. How about Detroit? It's interesting. You are seeing a little trend here that the Midwest so far, and again, doing these blind is an interesting way to do it because I'm just reacting to it along with you. They had their big boom Q2 of 2021, and then they had another pop Q1 of 2022, like everywhere else so far has. But they had this little pop right here, which is interesting that our two Midwest, Cincinnati and Detroit so far have both had that. Let's try Boise. Yeah. Now, Boise, this is interesting. Boise's the first one that we've had a real big difference here. Still the same general trend. I mean, you know, you're not going to pin it down to the month for everywhere. But again, they had their big boom of in 2021 Q2. And then they actually, when all these other places were having their big spike, they actually were still up, but were trending on the way down. And then everybody tanked Q2 2023 and then rebounded 2024. But it's all relative, guys. Like I'm saying, how about Tennessee? Yeah, Tennessee follows that trend. So it's interesting. You've got a trend from the first part of 2021 for kind of more of the Midwestern states, and then everywhere that's kind of traditionally those hot markets, it's Q1 of 2022. But that's going to vary a bit. But when it went down, I've yet to see any market we've looked up that didn't go way down. And then when they rebound, everywhere's rebounded. How about Las Vegas? We haven't looked that one up yet. Same thing. Every market that we've looked up had a trending peak right around here in that 2021 to early 2022. And then all of them had a huge drop off to Q2 2023, and then some form of a rebound in 2024. Every single market we've looked up. How about Montana? It's not even going to let me do Montana. How about New Mexico? So they're all going to follow that same trend, guys. Q2 2022. See if there's any other cities in California to let me look at here. How about Bakersfield would be an interesting market. Yeah, I thought so. My guess was that Bakersfield would follow more of that Midwest trend that we're seeing. So I think actually the trend seems to be, it's not really a Midwest thing. It's more of a, I'll call it a smaller city, but still large. These are all bigger metro areas we're talking about, versus those hotbed, extremely volatile markets that we're used to talking about: LA, New York, Miami. So here's a guess, and I could be wrong, so we'll see. I'll edit it out if I'm wrong. I'm kidding, but I'm going to look at Miami next. I would imagine by this trend, Miami probably peaked in Q1 of 2022, like LA did and some of these other big cities. But the smaller cities that are going to be a bit more stable, like the Boise, Idaho, like the Cincinnati, like Detroit, their big rise was the beginning of 2021, and then they kind of leveled a bit right here. So it's interesting that even in California, a city like Bakersfield, which is still a good sized city, just like Cincinnati is, and all that, about 500,000 people in the metro area, last I checked. I've stayed in many hotels there, driving back and forth. I like Bakersfield quite a bit, but anyway, they would be more in that trend. So let's look up Miami now. Yep. All right, we got it. I really was kind of nervous on that. So yeah, Miami follows what I'll call the volatile big city trend. So it doesn't make any difference that it's Florida with no state income tax or whatever it is versus Los Angeles. The Miami chart is almost identical to the Los Angeles chart, which I'll pull up again. Same quarter, same drop off, same rebound. And we'll do one more. I'm trying to think of the most. How about Iowa? Des Moines, Iowa. Interesting. Okay, so Des Moines actually followed more of that Miami, Los Angeles trend, but it's all still the same thing. Market goes up, market goes down. Oh, the one that I haven't done, that I've talked so much about, how about DC? Really curious about this one. And they followed. Okay, interesting. So they really peaked Q2 2021. So that would be right after the Biden administration comes in and the announcements made. And then, like every single other market that we've looked at, they dipped down and then they strongly rebounded in 2024. So that's the pattern, guys. And well, let's look at Alaska, if it'll let me. Alaska might be one of those outliers, I would think. It's not even going to give me Alaska. How about Utah? Utah, same thing. So I could bore you more with it, but I hope that kind of proves my point a little bit here, to where, and I want to be clear on this because this is a topic that you can kind of butcher and go back and forth with. If you want to argue about it one way or another, you can. So I want to be clear. Your local market does matter. I'm not trying to say that it doesn't. It more matters on what you personally like, in my opinion, especially depending on the use of the property. The rental rates, if you want to look at a chart that really matters, don't even worry about the home rates. Look at the rental rates and the occupancy rates. That's my 2 cents on it anyway. And then again, look at what you can buy. It's not so much about what the price of the home is. It's what the price to control the home is. It's what the price to acquire the home is, cash in your pocket, in your bank account for your down payment. It's more important about the structure utilized to purchase the property, in my opinion, than it is about the purchase price of it. Because you can take a $1 million property, and if you buy it cash and your cap rate, NOI, after all debt service expenses and all that, well, you wouldn't have any debt service if you bought it cash. On that $1 million property, if your cap rate is 10%, you're making 100 grand a year on that. If you did nothing different, same property, same purchase price, same management, same result, same cap rate, 10%, but you bought that property with 20% down and you got a 5% interest rate with interest only amortization. So now you're still making your 10%. So the property is still generating a net operating income of $100,000. Now deduct your debt service. So since you bought it with 20% down, You put down $200,000, so you owe $800,000. If you got interest-only amortization with a 5% interest rate, then that means your debt service on the property is $40,000 a year. So deduct that $40,000 a year from your $100,000 net operating income, your gross profit. Your now new net profit after debt service is $60,000 instead of $100,000. But because you invested only $200,000 in cash to buy it on finance terms, instead of investing $1 million cash to buy it outright, now you've invested $200,000 to get 60 instead of investing $1 million to get 100, which means you've turned your cash on cash return from 10% to 30%. And that's just math. Nothing's changed, nothing's different. It's the same property, it's the same result. The only thing that's different is how you purchase the property. And that's the biggest thing I can tell you is look at those fundamental details. That's so much more important. And you can sell me a lot of times realtors will ask me, well, what kind of property are you looking for? And I'll tell them anybody that wants to carry paper, I'd love to see it. Because it could be a trailer park in northern Arizona, which I love, by the way, northern Arizona, Sedona and all that, some of my favorite areas. But anyway, it could be a high-rise in Manhattan. It could be an oceanfront condo in Newport Beach, like the one we just thankfully got. It could be a hotel in Dallas. It could be a condo in Park City. It could be anything. It could be a house in Destin. It means nothing to me what type of property is. I don't care about what kind of food they serve. I want to know what the terms are, what's my projected rental rate that I can get, and what are the terms I can utilize to buy it, and what does the math equate to percentage-wise I'm going to get on a return. Because if you take $1 million cash and you can utilize 200,000 of it to make 30%, 60,000 on that 200, with the example I just gave, now go do that 5 times with that $1 million, and now you're making 300,000 on your $1 million cash instead of making 100,000. And that's when you start to, if you look at it from a percentage, don't worry about the dollars, look at the percentage return, have that be your focus and stick to that. Then I promise you that you're going to do a lot better with that mindset. At least that's my humble opinion. I could be wrong, but that's what I strongly believe. And this is from a guy that kind of got my start during one of the most horrific market tanks that this country has ever seen and probably will ever see. And so maybe I'm, got a little PTSD from basing things on appreciation, but I just know how strongly everybody always sounds when they're talking about, well, my local market is protected because of this or that or the other thing. And then how sad it is, I've, firsthand, again, having experienced it in Bend and other places and seeing it, how sad it is when they're like, oh, well, I guess this is possible that the market can tank in Bend or Vegas or Florida or Texas or California or anywhere else, and it has and it shall continue. But all we can do as investors and realtors and real estate professionals is try to protect ourselves as best we can and try to be as stable as we can from a cash flow perspective so we can weather the storm. Because if I take this chart back out to the max, going all the way back to 1980, you'll see, yeah, those crashes happen. But over time, because largely of inflation, if we can hold on to it, we're going to be pretty happy about it. And it always does come back around. And it always will, because the dollar is always going to continue to be worth less over time. There's always a need for housing. And so real estate is the best inflation hedge, in my opinion, and that's what it should be looked at. It should be looked at as an inflation hedge and a vehicle to create cash flow. And if you look at it as a vehicle to create monthly and annual cash flow and an inflation hedge, and don't worry so much about what the market value is doing or does, then I find it to be, then I believe you'll be much happier with it, and you'll see that it's a much more relaxed and enjoyable way to look at things. So I could have, believe it or not, I could have rambled a lot more on that, but that's just my shortest way I can dive into it. I hope it gives a little bit of value to anybody out there. And I hope if you're a nerd with these stats like I am, I hope you just enjoyed looking at some of the markets around the country, because that's fun to do and it's interesting. So thank you guys. I sincerely appreciate you being in our network. If you haven't already, again, please subscribe. We really do appreciate it, and have a blessed and prosperous remainder of 2025. And thank you for being a part of the network.